Well, I think, as you pointed out, things look really good. If the three big banks we saw reporting had very, very solid results. There were a couple areas of weakness, but nothing unexpected. So those areas are basically investment banking. The IPO market has dried up. People aren't issuing as much debt. So investment banking is still more rebound. It actually managed to go down another 15% overall for the market as a whole, compared to a very, very weak first quarter in 2022. But that's an aside. I think the trading activity was fairly positive. So overall, very, very good. One area of concern, as you point out, was real estate. So banks like Wells Fargo, who have a much larger exposure to real estate than maybe some of the others, suffered a bit as a result of that. But overall, very, very solid results. We also saw very good strength in terms of payments processing, in terms of credit cards and things like that. Although Jane Fraser at Citibank did point out that they've seen a big slowdown in terms of credit card spending in this quarter, but that was not seen at the other banks. So I think overall, very, very encouraging, very good results.
Let's just briefly mention investment banking, because we have seen corporate activity drop, and that represents obviously a loss of fee-generating income for those banks that are big in that space. But from the sound of it, most of the other segments of their business seem to be enough or doing well enough at the moment to offset some of that weakness.
Definitely. I mean, the investment banking is not an enormous part of a very large universal bank like JPMorgan's activity, nor is it the case at Wells Fargo, where it's relatively small. The other large investment banks, Goldman Sachs and Morgan Stanley, have a much, much larger exposure to that line of business. So we'll see what comes out with their earnings. But I think we'll see strength for those investment banks in the trading side. So we've seen fairly volatile, choppy markets. We've seen good trading volumes, both in fixed income and in equities trading. So that should see them through. I will say in these kinds of more volatile markets, some banks are more successful than others in terms of navigating them. So banks like Goldman Sachs historically have been very, very good in that kind of market environment. So that should benefit them. But we'll have to wait to see what happens with their results. But overall, it looks pretty good for those banks as well, though I don't expect we'll see the same kind of boost that we saw at JPMorgan. That was basically more broad-based in the commercial banking side of things as opposed to investment banking side. But nevertheless, it looks pretty encouraging. Everything looks really good.
Oh, not everything looks really good, Octavio, but I'm sure in the investment banks, I hear what you're saying, though. I think that they have proven that in the current environment, the current risk, they are well regulated, well capitalised and well run. I would completely agree with that, but I don't think everything is good. And I'm worried about other areas of the market. So are the areas such as the private markets, such as the shadow banking markets, such as the regional markets, are they as well run, well regulated and well capitalised?
Well, I mean, let's look at the regional banking market. Obviously, as you get into smaller banks, they tend to have greater exposures into individual lines of business and individual types of depositors. So they're more at risk there when things start to go wrong. And that's certainly what we saw with Silicon Valley Bank, we've seen with First Republic and Pacific West and banks of that sort. So there has been a bit of a flight out of there because they've tended to be more exposed to depositors who are sort of hot depositors who take money out very, very easily and quickly and try and get better returns from it. And we have seen, of course, interest rates on even very short-term US Treasuries hit 5% and even more now. So now on the 3 and 4 month US Treasury, you're getting well into 5% return on that. That's a much more attractive proposition than letting your money sit in a checking account at First Republic, which is risky and doesn't have any returns with it. So yes, those kinds of banks have, I wouldn't say they're not as well run. I think they're pretty well run, but they just have a different risk exposure. They're not as broad-based, and therefore they're more vulnerable when things start to sort of recede.